welcome to this Bell Direct monthly update. I'm Julia Lee, an equity strategist with Bell Direct. And first of all, let's start by having a look at where the market is in terms of long-term cycles. And given that the US stock market has a longer history than the Australian market, here we're looking at the S&P 500 from 1930 to 2017. You can see that generally the market goes through cycles of between 16 to 18 years, going between bull market cycles and bear market cycles. One of the characteristics of a secular bull market is that the uptrends in this type of market are much stronger than any corrections or downtrends that we see. So in 2017, being in a secular bull market, I'm quite optimistic the market and positioning for growth. In fact, looking at the Australian share market over the past 10 years, and you can see that when the market is rising, generally it's the growth areas of the market which outperform. This includes sectors like the materials, the energy, the industrial, as well as the consumer discretionary sectors. On the flip side, areas that usually underperform in a rising market include the property sector, the utility sector, consumer staples, as well as healthcare. So having a look at asset allocation in 2017, I'm keeping this in mind that history shows that it is the growth areas of the market rather than the defensives that outperform in the environment that we're in. But for the month of March, we've really just seen continued consolidation on the Australian share market. The S&P ASX 200 index in 2017 has simply been consolidating between 5,600 points and 5,800 points, and we've seen that continuing in March. We have a look at some of the best and the worst performance for the month, starting off with the best performers in the ASX 200 index. And Spotless has outperformed with a share price performance of 30%. This, of course, on the back of a takeover offer from Downer EDI. But outside of Spotless, those companies with exposure to China have been doing well. What we have seen is A2 Milk up by 21% as China looks to relax some of the regulations around online trading as of the 1st of January 2018. So A2 Milk, Blackmores as well as Bellamy's doing well in the month. We've also seen Australian Agricultural Co. up by 16%. This cattle company doing well because of the trade agreement signed with China, which means access for our cattle companies to all of China in terms of chilled beef sales. On the flip side, the worst performers have really been driven by the earnings outlook. Fletcher Building continuing to fall 19% during the month after an earnings downgrade. We've also seen Navitas down by 17% as it loses preferred supplier status in some regions for the Migrant English program. And Harvey Norman down by 16%. Concerns around an ASIC review into the accounts has a spotlight on how Harvey Norman treats troubled franchisees. But of course, the big thing during the month of March is that we have seen iron ore prices tumbling. In fact, iron ore prices have continued to see weakness. In the February month, we did see materials significantly underperforming with a loss of 3.7% for the sector in the month of February. This trend has continued in the month of March with a loss of 2.2% so far. But we have to remember that it does follow on 8 months of strong gains for this particular sector, and the material sector is still up 32% for the year. But from a technical perspective, just having a look at the materials index, and you can see that we've seen a break of the uptrend that has been in place for the best part of the year. In fact, we've seen a double top right at the top, which looks like an M shape. And the general rule with double tops is if you see the neckline breaking, then you usually see a tumbling in terms of the price to the height of the neckline to the top. So that means we're targeting about 9,500 points for the materials index. We're pretty close to that and looking at that region for support. Of course, if we do see a break of that line, that could mean more losses for the sector. So keeping a close eye and monitoring the miners as well as the materials index to see whether that support around 9,500 points does hold. And finally, finishing off with some interesting research out from Wilson showing how director trades impacts on share price. Wilsons has crunched the numbers from November 2016 up till the 17th of March 2017 and had a look at how directors buying and selling shares ahead of the results in February impacted on the share price. For directors who bought shares in the 90 days before the result was released in February, we did see outperformance of those company shares compared to the market by 5.8%. But directors who sold shares in the 90 days before their result was released to the market actually saw underperformance compared to the market of 5.6%. And if you put an extra filter on to have a look at those directors that own more than 5% of the company that ended up selling shares 90 days before the result, up till the 17th of March, we saw the company shares underperforming the market by a massive 9.7%. So I guess that's why it's important to monitor the substantial holdings notices, and particularly if company directors are buying or selling shares, as it can impact on the share price. That's the monthly update for March. I hope you've enjoyed the update and see you next time. I'm Julia Lee from Bell Direct.